This has been such a great week. The market is increasing its volatility in both directions. And we have to talk about what the next 60 days or the last part of the year is going to look like, because what it's telling us, what the market is telling us is hold on to your hat. We're going to have crazy increased volatility in both directions. I'm going to show you what I'm looking at, where I'm looking at it, why I believe we're going to have increased volatility, and what's coming to the end of the year or through the end of the year. Stick around, we'll get to that and so much more. Hey everybody, RC Peck here with Fearless Wealth, and this is my weekly update where I look at price charts, where I tell you the news that I'm hearing, whether it's out of China or Europe or Credit Suisse or Meta, but where you get my take on what's going on in the market from a price chart point of view. And this week we have to look at one specific price chart and what it's meaning for almost all the other price charts going on. Because we're going to have, I believe, a crazy next 60 days of the market. Now, this is going to help you whether you're all in cash or you're all in the market or you're all in bonds or you're all in fill in the blank, because it really is telling us the personality of what the market is in, or kind of the area the market is in right now. So I'm going to get to the price charts and show you exactly what is going on and even how you may want to play it. Okay, so with that, let's get over to this first price chart. So this is a price chart of the NASDAQ 100 index. So there's no dividends in this price chart. It's literally just the NDX, the NASDAQ 100, which was created in 1985. Now this price chart itself, I'm looking at 25 and a half years of data. And that blue, very smooth line on there is a 200-week moving average. So 200-week moving average. I'll do the math for you. That is a 3.8-year moving average. And you can see that it is trending up and to the right. It went flat in 08, but really since 08, 09, it's been trending higher. And today what we have is the NASDAQ 100 right at that 200-day simple. It's a simple moving average. And so I believe we're going to have a lot of volatility here. Buyers are going to want to come in, right? This makes sense that we will have a bump here. I think we should expect at least in the NASDAQ 100, an 18% bump, right? People call that a bear market rally because the general direction or the overall direction of the stock market is still down and entering its 11th month. That's a big deal. You have to go back. There's not a lot of periods in time where the market has been trending down for over 10 months. You can delete out a lot of periods in time, right? Because I'm just looking at time here, and the market's been trending down for going on 11 months. I'm recording this on Friday, the 28th, October the 28th. So we're going to have increased volatility because people are going to want to come in and buy that. They're going to want to buy at the 200 week. Now, they don't know they're buying at the 200 week. Maybe some people do. The point is that when we look at these 400 million richest people investing in the stock market collectively, we can really track their behavior. And so that's what we're seeing. Expect a bounce. I think the bounce should be somewhere between 18 to 20% on the NASDAQ 100. And so throughout the rest of the stock market, we will see what that equates to. Not everything is going to bounce. China is a stay away from. In fact, today, Friday, close of market, a lot of things were up. Not China. It is heading in the wrong direction. The world is voting on China and Hong Kong. Hong Kong is now China. It was handed back in 1997 after being separate for 150 years. So we also want to see what's not going up, because if it's not going up right now when everything should be going up through this bear market rally, this is our third bear market rally in this 10-month downtrend, then you can really see where things are weak. So expect really increased volatility in the market. The other thing I want to show you here, I want to divide this. Right now, you're looking at this price chart, and it's in US dollars. I want to change the currency it's in and put it into S&P 500 units. So this is called a relative price chart. And what I want to show you first is between the two blue lines, the two blue vertical lines, that's the dot-com crash. That period between there is about 30 months where the NASDAQ 100 greatly underperformed the S&P 500. And that is exactly what's going on now, right? If you look at the horizontal blue, the NASDAQ 100 attempted to break out to new lifetime highs relative to the S&P, but it couldn't. It had a double top and it tried to get back up into new lifetime highs and it couldn't. This makes me believe also that we are in one of these 40, 50, 60% corrections. And no, they just don't happen over a weekend, right? We were all taught in 2019 and 2023, things just turn around in a week or a month. That's actually not how the market works. It takes time. And so the NASDAQ 100 is underperforming and has been underperforming the S&P if we look back since the beginning of 2021. That's 22 months ago. This is to be expected when we have these kind of catastrophic 50+% corrections. And so that's what you're seeing on the price chart right here, that the NASDAQ relative to the S&P, I'm looking at two indexes in the sense that I'm taking the NASDAQ 100 and I'm pricing it in S&P 500 index units. It's now below the 200-week moving average. So that should probably continue to weaken relative. What that means is we're going to see traditional parts of the market, industrials, XLI, energy, those should outperform relative. They all still might fall, but this is a period where tech is going to get hit harder in this correction, which means at the bottom of this correction, tech is going to then turn around. And as you can see on the screen, it's going to then, I believe, outperform, but not before it takes a lot out. So we're going to see increased volatility, especially with this relative price chart below the 200-week simple moving average. So what do I mean by increased volatility? So look at Meta here. Meta is, I shouldn't say I hate, them changing the name of their company apparently did not help. So here's Meta here. This stock, this company used to be $1 trillion company. It's lost 75% of its market cap. 75%. It is hated. Now, it gapped before. It had a big gap here at the beginning of 2022, and it had another big gap here this week. Literally, it opened down 25%. That's a stock that was already down. Let's just measure it here. Before it gapped down 25%, it was already down 65%. So as of close Friday, this stock is down 75%. So that huge gap down, that's what I'm talking about, volatility throughout the market. We're going to continue to see that. Now, I said in the intro, potential buying opportunities between here and the end of the year. Meta could be a buying opportunity because it is so far down. I do not believe Meta is going anywhere. I do believe they should never have gone into the metaverse and spending tens of billions of dollars. And the market is literally yelling at Mark saying, hey, Mark, bad idea. Sheryl Sandberg is gone, so she can't even tell him what to do. Not that maybe she was even able to. But let's see if Mark responds to this 25% gap down. I believe he's going to say something. Because back when the company IPO'd and it was falling hard, he actually came out near the low and said, I'm not selling any of my shares. And that one comment actually created the bottom of the stock over the last 7 years. So that is just a huge, this is real volatility. Amazon, it gapped down overnight. It was actually down in after hours trading, down 20%. And I'm purposely showing you these price charts with open, high, low, close candlesticks. So you can see these big gaps where buyers came in. Buyers were coming in to buy Amazon. It's split adjusted here at around 100, right? So if you believe Amazon is going higher, it has to stay above $100. But that was a huge gap down. So we're seeing this in not all mega cap tech, but we're seeing it in a lot. This is Microsoft, one of the largest publicly traded companies on the planet. And it had corrected 37%, which looks small compared to a Meta as far as a correction. But we're seeing big corrections go on. NVIDIA, which is a massive company, not going anywhere. I believe, I'm going from memory here, but I'll look, down 65% before it corrected. Yes, look at that, 69%. That is amazing. This stock is not going away, meaning it's not going out of business. So we're seeing these major companies down 75%. We're in a strong period of the year, of the calendar year. We're in a strong period of the election cycle. So literally over the next 6 trading days, again, I'm recording this close of market Friday, October 28th, is the strongest 6 trading days of the year, which means it's also the 6 strongest trading days of this 4-year election cycle. So expect some strength, expect the market going up. And, the market really is bifurcating. It's really separating between tech. And tech goes through, tech is a very general term, because even if you own the S&P 500, those 500 shares, tech is still 25% of the market or more. Tech is in almost everything. Google is not officially tech, it's communication. So the whole tech thing is kind of difficult to understand the way that the S&P, the company Standard & Poor's, has broken this down. But we're going to see increased volatility in the market. And one thing that's interesting, let's just pop over to the bond market. Bond market has done a little stabilizing right here. So we could see a bump, but next week we have the Fed coming out, probably saying they're raising interest rates 0.75%. So they're still raising their interest rates. They still want to see inflation come down. Inflation apparently turns out is much stickier than they thought it was. This is a price chart of the yield of the 10-year Treasury. And today, if you give the U.S. government your money for 10 years, they will give you 4% back each year. It's yielding 4%. But there are a lot of headwinds in front of us. I want to wrap this up. There's still a lot of headwinds in front of us. Real estate is absolutely getting hit very hard. A 30-year mortgage is above 7%. That is a big deal. That is making the same house way more expensive. It's making people stay in their homes longer. It's making people who want to buy a house wait. Real estate is falling hard. It's down 25% across the major growth markets in the country. Think Seattle or San Francisco or Austin. These areas that saw a lot of growth, they are all down about 25% from their peak. Now, the peak was high, but the point is that real estate is correcting, and that's a huge part where people's wealth is. The other thing, during the pandemic, there was a lot of fiscal spending. So let me just change the language. The government sent a lot of checks to a lot of people. That money, that cash in the bank, is going fast, right? So that means that is going away. We have headwinds coming in front of us. China is completely closing itself off from the world, not giving economic data. Xi Jinping is basically getting rid of anyone who does not agree with him. He's indefinitely running the country. He is literally putting only people who support him in place. China is the second largest economy on the planet. And they're about to go dark. And then probably they will invade or somehow take over Taiwan. And that's part of the reason why the world is getting out of Chinese stocks. And I think you should stay away from Chinese stocks too. So the global economic view is still dark. It's still darkening. There is still a land war in Europe. There are still huge energy issues for Europe. Those have not gone away. The market is definitely digesting what is going on, and we are in a period where we should expect to see a very strong market over, for sure, the next 5 or 6 trading days, and also to the next 60 days. Expect that, 18, 20% bump that we should see. Thank you for being in my world. Let me know where you think I got it right, where I got it wrong. If you would like to see how we manage money, the next step is super simple. You can just go down into the description and email us hello@fearlesswealth.com just to see how we manage downside risk and how we manage growth. I think people want full market growth when the market's in strong hands, when it's trending up for 5, 10, 15 years. And they want to make sure they guard against these catastrophic losses. So let me know where you think I got it right, where I got it wrong, what you liked about the video, what you didn't like about the video. I do appreciate you being in my world, and I will see you on the next one. Okay, bye.